Hi there, welcome back to Finance Talks My Robot family. In today's video, we are going to talk about the power of dividend investing. So before starting this video, please like this video and subscribe to this channel for our future updates. When comparing the two forms to get paid to invest, capital gains and dividends, understandable it's that dividends will appeal to you more. The market's performance in a given year has a huge impact on a stock's capital gains potential. Stocks can buck a downtrend, but they rarely do. Dividends, on the other hand, are normally charged regardless of whether the stock price is up or down. Dividends are dependable, which is one of the key reasons to consider them when purchasing stock. While not every stock must pay a dividend, a stable and reliable dividend stream adds consistency to a portfolio's return. For example, the consumer products behemoth Procter & Gamble has paid a dividend every year since 1891. Since 1891, the stock price of Procter & Gamble has not increased every year, but shareholders who held the stock were compensated during the down years. They weren't entirely reliant on capital gains to make ends meet. Payback on your initial investment. The rising dividend stream protects against inflation while also speeding up the return on investment. Consider payback as a safety net for equity investing. While no one can predict how a stock will perform over time, estimating a payback period will help you assess an estimated baseline performance, or worst-case scenario, for recouping your initial investment. Many investors compare two stocks and choose the one with the greatest potential for growth over time. This focuses exclusively on the reward. When calculating a stock's payback based on dividend flow, you must consider the following question. How long does it take for the dividend payments to pay off my initial investment if this stock never makes me any money in terms of price appreciation? Consider the following case to better appreciate the idea of payback. Assume you purchase 200 shares of a $40 portfolio. Your investment is $8,000, and the stock pays a $1.20 per share annual dividend, a 3% yield. You should expect to earn $240 in dividends the first year based on the dividend. If the dividend stream remains constant, you'll recoup your $8,000 investment in about 33 years. What if the dividend stream just increased by 5% a year? In 20 years, you will have recouped your initial investment. To put it another way, the payback period will be shortened by 13 years. The movement of the stock price over time has no bearing on this estimate. The stock's yield has no bearing on it over time. To measure the time it will take to recoup your initial investment, it only makes one assumption: projected dividend growth. Will you concentrate on stocks with the fastest payback? Certainly not. The net return is what matters in the end. It's nice to own a stock that pays back your initial investment in 15 years, but it's even better to own a stock that raises your initial investment 5-fold in the same amount of time. Even so, using dividend payback to frame the risk-return potential of two stocks is a worthwhile idea. The dividend payback matrix uses dividend yields and dividend growth assumptions to calculate payback periods, in years. Dividend-paying stocks allow investors to get paid even though the market is volatile and capital gains are difficult to come by. They are a good inflation hedge, particularly as they develop over time. Unlike other types of revenue, such as interest on fixed income portfolios, they are tax-advantaged. Dividend-paying stocks are less volatile than non-dividend-paying stocks on average. And a steady stream of dividends, particularly when reinvested to take advantage of compounding, will help you create significant wealth over time. Dividends, on the other hand, come at a price. Dividends to shareholders cannot be paid without affecting the company's stock value. Consider your own financial situation. Your net worth would decrease if you continuously gave money to family members. It's the same for a company. A company's capital that it pays out to shareholders is money that is no longer part of the company's asset base. This money is no longer available to reinvest and expand the company. The decrease in the company's wealth must be expressed in a downward stock price change. When a dividend is paid, the stock price drops. The change may be difficult to note among the daily price fluctuations of a typical stock, but it does occur. When a business pays a special dividend, this change is even more apparent, also known as a one-time dividend. The stock price is automatically lowered when a business pays a special dividend to its shareholders. The ex-dividend date. The ex-dividend date triggers a downward change in the stock price. The ex-dividend date is typically 2 business days before the record date. The ex-dividend date is the deadline for obtaining the dividend payment. To obtain the next dividend payout, you must own a stock prior to the ex-dividend date. You are not entitled to the next paid dividend if you purchase a stock on or after the ex-dividend date. If this seems to be unjust, keep in mind that the stock price changes to represent the dividend payment. As a result, you will pay a lower price for the stock if you buy on or after the ex-dividend date, even though you will not be entitled to the dividend. The following is an example of how the ex-dividend date, record date, and payable date interact. XYZ, Inc. announces a dividend payable on March 1, 2019 to its shareholders on January 10, 2019. XYZ also declares that the dividend will be paid to shareholders of record on the company's books on or before February 8, 2019. After that, the stock will go ex-dividend 2 days before the record date. The record date falls on a Friday in this case. The ex-dividend date is 2 business days before the record date, which is February 6 in this case. The dividend will not be paid to those who purchased the stock on Tuesday or later. That dividend goes to the seller of the shares. The dividend is paid to those who buy before the ex-dividend date. Many investors assume they are entitled to the dividend if they purchase on the record date. Stock trades, on the other hand, do not settle on the day you buy them. You must be a shareholder on the record date, which means you must purchase the stock by that date. The settlement period is essentially expressed in the ex-dividend date. Dividend capture strategies. You might wonder if buying the stock just before the ex-dividend date and selling on the ex-dividend date is a way to just get the dividend payout. Not yet, says the response. Bear in mind that the stock price will change to represent the dividend payment. On February 5, 1 day before the ex-dividend date of February 6, you buy 200 shares of stock at $24 per share and sell them at the close of February 6. The stock pays a 50 cents per share quarterly dividend. On February 6, the stock price will be changed downward to reflect the 50 cents bill. Despite this change, it's likely that the stock will end the day on February 6 at a higher stage. It's also likely that the stock price would finish the day on February 6 at a lower level than the $23.50 indicated by the 50 cents dividend adjustment. Assume the stock changes perfectly and you sell at $23.50 a share for the sake of this example. Is it better or bad to take advantage of the dividend? You'll get 50 cents per share in dividends, but you'll lose 50 cents per share due to the stock's drop in value. It seems to be a toss-up. What about taxes though? Isn't it true that dividends are actually taxed at a high rate of 15%? The response is, yes, but there is a snag. You must keep the stock for a certain number of days in order to enjoy the preferred 15% tax rate on dividends. Under the 121-day cycle preceding the ex-dividend date, the minimum period is 61 days. 60 days before the ex-dividend date, the 121-day period starts. The day the stock is disposed of, not the day it is purchased, is calculated when calculating the number of days. The dividend is not taxed at the preferential 15% rate if the stock is not kept for at least 61 days in the 121-day period preceding the ex-dividend date. Instead, it is taxed at your regular rate. To recap your dividend capture strategy, you paid $4,800, plus commission, to purchase 200 shares of stock. You are entitled to a 50 cents per share, or $100, dividend if you purchased before the ex-dividend date. You'll have to pay taxes at your normal rate because you didn't keep the stock for 61 days. Assume you pay taxes at a rate of 28%. After taxes, your take-home pay is $72. You made a $100 loss by selling 200 shares at $23.50 for $4,700, plus commissions. You now have a realized, short-term loss that you can offset against realized capital gains or up to $3,000 in ordinary income if you don't have any realized gains. The dividend capture policy did not work out in this situation. You've lost the commissions from buying and selling the stock, you've realized a loss that you may or may not be able to write off immediately, depending on how many realized gains and losses you already have, and you've missed out on the preferred 15% tax rate on dividends because you didn't keep the stock long enough. The bottom line. There are no free lunches on Wall Street, and dividend capture techniques are no exception. Dividend capture techniques are difficult to benefit from due to fees, taxation, and downward dividend payment changes. Keep this in mind the next time you're thinking about purchasing and selling stocks purely for the purpose of earning dividend payments. What do you think about our video? Are you planning to invest in dividend stocks? Let us know in the comments below. I just wanted to say, thank you so much for watching. If you're still watching, you're an absolute legend, and remember to smash the like button and the subscribe icon so you get the latest updates when we post the new videos. See you soon.